Good day, fellow investors. Today we're going to give an overview of the current stock market and what can be the outlook going forward. We will especially focus on factors that we can know, estimate, and factors that we cannot estimate, because there are many scenarios, and when it comes to investing, and we'll discuss that towards the end, you have to think, okay, how am I impacted if this happens or that happens? And the main question you must be having in your head is, how much more will stocks keep crashing? If we look at the market year to date, bear market 20% down, and you can see that it goes down, then we have a bounce, then it goes down again, bounce, down, bounce, and now we go down again, and the trend is pretty clear. The question is, when will this trend stop, revert? And that's what we are going to discuss in this video. And there are many predictions, and I really wish I could tell you, okay, it's going to stop at this level, at that level, and this level, then it's going to bounce back, rebound. The real truth is that nobody knows. And I really enjoyed this interview with Druckenmiller, who is the greatest trader and understanding person about these trends. And really, I'll put the link in the description below for his interview at the Sun conference. Really amazing interview. And the most common answer that he gives is, I don't know, this can happen and that can happen. Of course, there are different probabilities, but we have to understand what can happen, which should make our investing easier. I just listened to the interview, so really great. If you watch it, then you'll see this guy constantly nod, so that's a funny thing there. So as I said, discussing what can impact stocks is that nobody knows, nobody can predict the future, but there are scenarios and we have to keep those in mind. Druckenmiller simply said that there is a low chance, really unlikely chance of a soft landing, but then again, given the monetary environment we are living in, the Fed constantly reacting, injecting money into the system, you never know, maybe there will be a soft landing. On when a recession will come, again, impossible to predict whether it will be this quarter, whether we are already in a recession, or it will only happen in 2023, 2024, because for now there are so much excess savings that are still going into the economy. That's why also inflation is higher, that you don't know when those will dry up. Maybe even governments will react again and push more money to people to help them with inflation, like some in Europe are doing. So you give more money to people to help them with inflation. Genius. But that's what they are doing. If we look at the personal saving rate in the United States, you can see it booming here, given the helicopter money, people staying at home, not being able to spend. And now we see that going down, but this extra savings is entering the market, pushing prices higher, competing for services, goods. So that is also one reason why we have inflation. There is still room for this to go lower, and especially if people start getting the feeling that there will be inflation, they will spend more to buy now at lower prices, which will further exacerbate inflation. Also something very interesting, if you look at bankruptcies in the United States, but across the globe similar, you can see, of course, after the great crisis, the number was very high. Now, with the last 2 years, the number of bankruptcies is incredibly low. So there is a huge distortion in the system. Nobody is allowed to go bankrupt. Everybody is helped. And that is also something that changes really the way we look at markets, at developments, because this is totally artificial. And when something is artificial, you cannot predict, because it all depends on the generators of that artificial environment, the Fed, the governments. It all depends on them and how they will react. But then we can focus on fundamentals, and if we look at what Wall Street analysts are doing, they are still very bullish. If we look at expected earnings growth for 2022, it is still at 10.4%, even higher than the expectations at the end of the last quarters. 1 percentage point higher growth earnings expectations. So very, very bullish. 2023, a little bit lower, but still earnings expected to just keep on growing no matter what. You practically don't even see any issues here over the last months. So really, really bullish, huge growth and increased growth perspective. And with high earnings, you can see here that the price earnings ratio is low, which makes stocks very, very cheap from that perspective. However, we must understand that analysts usually are lagging what really happens. The stock market is already going down, expecting worse fundamentals, but there is also the impact of higher interest rates. And now the question is, who will blink first, the Fed or the government or investors? Because if you look at the 10-year treasury, which is usually the most important price when it comes to investing to financials, it went from practically zero to 3%. Keep in mind, now with inflation at 8%, this is still yielding negative 4-5% real returns. So if you invest in the treasury, all else equal, over 10 years, you likely lose 50% of your purchasing power. So that is still how artificial the environment is. Of course, now at 3%, the market is looking at things much differently than at zero. If I compare the treasury with the S&P 500, you can see here, when interest rates start going up, the market starts getting a little bit more negative. Then when the Fed sees interest rates can't go higher, then with declining interest rates, then you see stocks going higher. Then of course we had this scare here, but you can see low interest rates and stocks went just higher. If I put this to 1 year, over the last year, you can see really a divergence. So when it was clear that the Fed will start tightening, will start increasing rates, you can see that the S&P 500 went lower and lower as rates moved higher. This is because you are comparing the risk-free return 10-year treasury 3% with the dividend yield of the S&P 500 1.5%. When the treasury is at 1%, then the dividend looks better. When the treasury is at 3%, then the dividend looks not that good because of the risk. So you want a higher yield or earnings or whatever as the interest rates, the risk-free interest rates goes higher. And that is what pushes then stocks lower. Now, the question is, what will the Fed do? If they continue, if they want to stop inflation or curb inflation, they should now push interest rates to 8%, which means that expected dividends would likely be 5, 6, 7% for the S&P 500, which means that it should crash to 1,000 points or something, which is really, really crazy. So that's something that is unlikely, but possible if the Fed pushes. Then also, if the Fed pushes interest rates higher, budget costs will be higher to pay the interests, which is again something that the Fed will not do, or it will have to start buying treasuries. So the Fed is in a position where now they are saying we are tightening, curbing inflation, but there is one certainty with these things. When the Fed says something, is usually wrong. 2 years ago, they said no interest in increasing rates. Then they said inflation is just transitory. Now they are saying inflation is here for good and we are going to hike till eternity. So always keep in mind that what the Fed is saying, they're saying it because they have to say it, not because they will actually do it. So maybe in 6 months they can change their mind, which would then lower rates, push stocks higher in a strong inflationary environment. We don't know what the Fed will decide. Depends on how much pain will be felt in the markets, with people, with politicians, with everything. Very important point from Stanley Druckenmiller, that never when inflation went above 5%, we have seen it get back without a recession. So that is historical evidence that without a recession, it will be very, very hard to curb the inflation. Of course, he also said that if inflation is at 8%, interest rates should go above it to curb it, but maybe first time in history they will be able to curb it with 4 or 5%. But recession likely inevitable. When? Impossible to know. Maybe they will decide to let the inflationary environment run for longer with all the consequences that are there, but still nobody thinks about those consequences because you don't feel them yet. But with the costs of living going higher, you will just start feeling them now. So they are balancing that, and we don't know, not even they know how that will balance out. And now, when it comes to investing, I have one beautiful chart from similar times to current times. In the 1960s, stocks were higher, everything was booming, and you can see here how from 1965 the Dow didn't go far for, what is this, 15, 16 years. And you can say, okay, zero returns over the long term, but no, zero returns doesn't mean that the market will not be crazy. It will go up, it will go down, it will go up, down. So this is what we can expect in a market. So now we are, let's say here, everybody's negative 25%, and most people out there think it will just keep crashing. However, if the Fed reacts, if this or that, it can boom again, then negative, then boom, then negative, then boom, then negative. Depends on how the Fed pivots, etc., etc. This is what makes investing unpredictable now. And then again, as Druckenmiller said, stocks lead fundamentals by 6 to 12 months. We will only see the repercussions of the recession, of the slowing down, of the higher rates 6 to 12 months down the road. So those earnings estimates from 2023 will likely go down, which will further impact stocks. Maybe there will be a temporary boom if we have good economic data, lower inflation, stocks will go up because the Fed will not have to hike that much. So it is impossible to predict. I always focus on value. Tomorrow we'll start with the Vanguard High Dividend Yield ETF, the first top positions, and we'll always look for those business value no matter what happens with the environment. So always think about investing, okay, if we have inflationary environment, how does my business do? If not, how does my business do? How does that impact me? And that's the core of long-term investing for us. Check what I do here on my research platform for my really deep core dives and researches. Thank you, and I'll see you in the next video.